Hello and welcome to Weekend Investing Daily Bytes. Today is 21st of April. We are shooting episode 214 and we're going to talk about the importance of having a plan and having a strategy on which your portfolio is running. And we'll show you why this is so important. First, a look at the markets. So, markets were reasonably buoyant today, coming off from the fall that we saw on Tuesday. Yesterday was a sideways kind of a movement, but today, after the initial first couple of hours of some hesitation, the market then took off, led by autos and banking, along with reversals in IT, reversals in infra, energy stocks, real estates. Pretty much everything was in the green today. It seems like market has shrugged off this earlier in the weakness and is now willing to go up once again. That's the sort of assumption that I would make looking at the markets. In terms of broader sectors, you can see here all indices, whether mid caps, small caps, Nifty, Next 50, CNX 200, everything was up between 1 and 1.5%. Many of these weekend investing small cases were also up between 0.5% and about 1%. So while the major indices like Nifty were running up very hard, the internals of the market were not running as hard as Nifty. So that is still a bit of a concern, but nevertheless a reasonably good day from all perspectives. Within the CNX 500 universe, there were some large gainers. So some IT stocks, Zensar Tech 8.37% up, Future Consumer 8.3% up, L&T Finance up 9%, PNC Infratech 11%, Angel One was up 17%. It's a huge win for the broking company. But on the other hand, ICICI Securities was down 5%, Capri Global was down 5%, Kalpataru Power, Phoenix Mill, Jindal Steel also down between 3 to 4%. So some winners and some losers in the top line as well. We were tracking Netflix stock since yesterday after the earnings and some loss of subscribers and the whole story about how a growth stock gets priced to the perfection, and then once its growth disappoints even for a few quarters, how it is it comes collapsing down. So Netflix is a very good example of this. The stock had been going up and up and up, reached about $700, and just 4 or 5 months back it was trading at 10 times 2022 revenues. I mean, that is unheard of actually. I mean, to trade 10 times of revenues, that was the kind of bullishness that was there, and it has dropped 70% since then, and now it is trading at 15 times 2022 EBITDA, which is very reasonable from the perspective of valuation. But when the bull market comes, all caution is thrown to the winds, and instead of EBITDA multiples, you start looking at revenue multiples. So this is a very good example of how growth stocks can suddenly break the journey for its investors, because investors are expecting that growth to keep on continuing, and nothing grows to the sky, as they say. So, and in Indian context, we have so many who I call dinosaur stocks. Very good quality, very good companies, no issue about that. But at 80 times price earnings, if you are having a company which grows at 10%, I don't understand valuations too much, but I mean, even for a layman, that is a bit of a stretch. So one such company today that I highlighted was Nestle India. So always have a plan, always have an exit plan, always have a position sizing plan. How much are you going to allocate to any one stock? How you're going to change your plan by when things are changing in front of you? How long are you going to wait? There should be a strategy. A lot of times what will happen is that things will not work as per your plan, as per what you're expecting from your stock. Why? A lot of times, most of the times I would say, it will not happen the way you think. And hence that framework is needed, where that framework should tell you that okay, so you are looking ahead for this to happen, but this has not happened, and alternatively this is happening. So now, as per the framework, you should be cutting out, or as per the framework, you should be reducing your quantity, or so on and so forth. So Bill Ackman, one of the star fund managers in the US, has sold his stake in Netflix from his fund. They have taken a hit of some huge amount, $400 million, I think. And the market cap of Netflix in this fall, this 36% fall that we saw yesterday, is down somewhere close to $59 billion. Just to give you an idea about what is the size of loss that we're talking about, the entire market cap of State Bank of India is about that much. So one State Bank of India got lost because of disappointment on earnings growth. That is the kind of level of scale of money that is moving in those markets. Other examples are there. Zoom Communications, darling of the COVID trade, is now down 81% from where it has peaked in October 2020. Another one is Netflix, of course, or Peloton. Peloton is down 86%. Netflix is down 67%. PayPal is another stock that has been just getting hammered, is down 68. So there can be so many instances where the stock is very sought after, stock has a sexy narrative, but the stock price is against you. And what will you do? Your stock price keeps falling. You need to be prepared for this situation in any of the stock that you may be holding. It may be the best of blue chips that you may think that nothing can go wrong. There is no such stock where nothing can go wrong. Let's put it this way. It's difficult to believe when I say this, but if you will adhere to this basic principle that do not trust any stock to do well forever. That's the basic underlying bottom line. The other gorilla in the room is the 10-year trajectory of this treasury yield. There was this very nice tweet. I should have given the credits. I'm sorry, I have not missed the credits on this. But very nice tweet where different phases of increasing yield trajectory have been summarized along with various crises that have happened. So, very recently, for instance, December 2013, we had the emerging markets crisis. Before that, you had the great financial crisis here, 2008. So every peak is kind of denoted by some crisis, beyond which obviously the yield starts to drop and the economy goes into a recession. So we don't know where this 15 will go to, whether it will start dropping from here, it will go here, and then drops, etc. But this is very, very ominous about some dramatic event to happen in global markets. And given the history and the current situation where the entire global debt situation is so bad, and as the interest rates increase, some dominoes will start to collapse because the debt servicing is becoming impossible. So this is definitely a huge macro headwind. How it will pan out is anybody's guess, but this has to be kept into mind, that it is not a normal environment to invest or trade in. There may be hiccups, so asset allocation becomes all the more important. Definitely keep investing in stocks, but do make sure that you have an asset allocation and a hedge to your stock. So, this is all I have for today's daily bite. Thank you so much for watching this and sharing this with your friends and family. Thank you.